Here's a sentence your bank hopes you never think about: a bank is not a vault, it's a business, one of the most profitable business models ever invented, and its raw material is you. Your paycheck, your patience, your inattention. The biggest American banks earn tens of billions of dollars in profit every single year, and most of it comes from ordinary checking account customers who believe their bank is a free service. Today we're walking through exactly how that machine works, the 5 ways your bank quietly turns your money into their money, and then the 5 moves that flip every single one of them in your favor. Because once you see the machine, you can't be fed into it. Trick 1, your deposits become their profits. When you deposit $10,000, the bank doesn't store it, it lends it out, as mortgages at 7%, car loans at 9%, credit cards at 24%. And what does it pay you for supplying the raw material? At the big national banks, the average savings rate has hovered around 0.01 to 0.1%. Do the math on that spread, they might earn $700 a year lending your money while paying you $10. That spread, banker jargon calls it net interest margin, is the single largest source of bank profit in America. It's a brilliant model, and here's the twist: nothing about it requires your specific bank. High-yield savings accounts at equally insured institutions routinely pay 40 to 400 times the big bank rate, for identical safety. The only thing keeping the spread that wide is customers not moving. And banks know exactly how sticky you are. Industry surveys show the average American keeps the same primary checking account for about 17 years, longer than the average marriage lasts. They're not betting you'll never notice the rate. They're betting that noticing won't be enough to make you act, and for 17 years at a time, they're right. Trick 2, the fee machine. Banks collect billions every year in overdraft fees alone, and the mechanics deserve a closer look. A $35 overdraft fee on a $20 shortfall that lasts 3 days works out, annualized, to an interest rate in the thousands of percent. Some banks were caught reordering daily transactions, processing the largest ones first, so a single shortfall became 3 separate overdraft fees instead of 1. Add monthly maintenance fees for the privilege of holding your money, out-of-network ATM fees where both machines charge you, paper statement fees, wire fees, inactivity fees. None of these are the price of a service. They're the price of friction, and they're aimed overwhelmingly at the customers with the least cushion. The fee machine runs on one fuel: people too busy or too tired to switch. Here's the part that should genuinely bother you: these fees are regressive by design. The customer with $50,000 parked in accounts gets every fee waived automatically, while the customer scraping by pays $35 for being $20 short. The people funding free banking for the wealthy are the people who can least afford to. Banks don't advertise that arithmetic, but their annual reports do. Trick 3, the minimum payment trap, the crown jewel. Credit cards are the most profitable product in consumer banking, and the minimum payment is why. That friendly little number, just $25 due, is not a suggestion designed to help you. It's calibrated, usually around 1 to 2% of the balance, to keep you in debt for as long as legally possible. Carry $5,000 at 24% and pay only minimums, and you'll be paying for well over a decade, handing the bank more in interest than the original debt, for purchases you likely won't even remember. Here's the detail that reveals the whole game: inside the industry, people who pay their balance in full every month are called deadbeats. The bank's ideal customer isn't responsible. It's someone drowning slowly, politely, and on schedule. And the trap is engineered deeper than the number itself. The minimum is displayed first, largest, and pre-selected, a psychological anchor that research shows drags even people who could pay more toward paying less. In studies, simply seeing the minimum payment figure lowered what people chose to pay. That's not customer service design. That's behavioral science, aimed at your wallet. Trick 4, the invisible skim. Every time you tap your card, the merchant pays an interchange fee, roughly 1.5 to 3%, that flows back to the card networks and issuing banks. You never see it, but you pay it, because merchants price it into everything on the shelf. This is how your bank profits even from customers who never pay a cent of interest: billions of swipes, a slice of each. It's also exactly where cashback rewards come from. The bank collects 2 to 3% on the swipe and hands you back 1 to 2, keeping the difference, and hoping the rewards points lure you into carrying a balance, at which point Trick 3 takes over and eats every reward you ever earned, many times over. Trick 5, engineered convenience. Why does every bank push its app, one-tap payments, buy now pay later at checkout, instant pre-approved credit line increases? Because decades of behavioral research say the same thing: the less friction and visibility a payment has, the more you spend. Studies find people spend significantly more with cards than cash, because tapping doesn't feel like anything. Every innovation in consumer banking for 30 years has aimed at one target: separating the moment of spending from the feeling of spending. The bank calls it a seamless experience. A casino designer would recognize it instantly. Run a personal experiment if you doubt it. For 1 week, pay for everything with cash you withdrew on Monday. Watching physical bills leave your hand reactivates the exact pain signal that Tap to Pay was built to silence, and most people who try it report spending 10 to 20% less without feeling deprived once. You don't have to live that way forever. But knowing the dial exists, and who's been turning it, changes how you tap forever. So that's the machine. Now let's flip it: 5 moves, 1 for each trick. Move 1, relocate your savings. 30 minutes to open a high-yield account at an FDIC-insured online bank, and the spread that was feeding them starts feeding you, hundreds a year on a 5-figure emergency fund, for zero added risk. Move 2, stop paying fees, permanently. Switch to a no-fee checking account at an online bank or credit union, and remember, credit unions are non-profits owned by their members. Their profits become your better rates. Turn off overdraft coverage entirely so a declined card, mildly embarrassing and free, replaces a $35 fee. In a world with this many free options, a banking fee isn't a cost of living. It's a voluntary donation. Move 3, break the minimum payment spell. Pay the statement balance in full, every month, and the 24% weapon becomes a free 30-day loan with rewards attached. If you're carrying a balance now, make its interest rate your public enemy number 1, avalanche it down before investing a spare dollar anywhere else, because nothing on the market reliably beats erasing a 24% charge. Congratulations on becoming what bankers call a deadbeat. Wear it proudly. Move 4, make the skim pay you. Since interchange is priced into everything whether you like it or not, use a flat-rate cashback card, paid in full, and claw your share back. Just respect the rule from Trick 5, rewards only reward the person who never pays interest. Move 5, and this is the big one: become the bank. Notice what a bank actually is: an entity that owns income-producing assets and collects interest while it sleeps. You can simply be that. Buying broad index funds makes you a part owner of the very banks running this machine: JP Morgan, Bank of America, Visa. They're all sitting inside the S&P 500, paying dividends to their shareholders. Money lent, at interest, to careful borrowers, through bonds and funds, earns you the spread instead. The endgame of financial literacy isn't defending yourself from the machine forever. It's quietly buying shares of the machine. The bank was never evil, it's just a system with 2 sides, and nobody ever told you that you're allowed to choose which side of the counter you stand on. Choose this week: move the savings, kill the fees, break the minimum, claim the cash back, and start owning what used to own you. One warning before you go: when you make these moves, your bank will suddenly discover how much it values you: retention offers, waived fees, a nicer rate, the works. Enjoy the irony, take the deal if it's genuinely best, but remember what it took to be treated well, proving you knew how the machine worked. That knowledge is the whole game, and now you have it. Please like to support the channel, and subscribe so you can keep up with our upcoming videos. Financial literacy is not a choice.